Well, good evening, ladies and gentlemen, and welcome to the LSE, this fabulous new building, and welcome to the Systemic Risk Centre. My name is Michael Power. I'm Professor of Accounting here at the LSE, Fellow of the British Academy, and I'm really pleased to introduce Daniel Beunza, who's come back to the LSE today and is going to be talking about his fabulous new book. Actually, I was telling Daniel just a few moments ago that it's Friday night and there probably won't be too many people here. I was very wrong, so you're all very welcome. Daniel is one of the leading second-generation scholars in the sociology of finance. He's published very widely, including important papers on the sociology of arbitrage and algorithmic trading, both of which feature in this new book. He obtained his doctorate from NYU and was formerly a lecturer in management here at LSE. And currently, he's reader in voluntary sector management at Cass Business School and a research associate of the Systemic Risk Centre. The title of his talk today is the title of his book, Taking the Floor, Models, Morals and Management in a Wall Street Trading Room. We're looking forward to what Daniel has to say shortly, but I think it's fair to say, and he would agree, that this book was delayed for many years. The data, much of it was collected before the financial crisis and then had to be rethought and reinterpreted and extended in the light of those momentous events of 2008. In fact, a number of us had to do that. So the result is, I think, a much richer, compelling narrative with very interesting systemic messages, which Daniel will talk about, notwithstanding the kind of ethnographic methods which Daniel has employed to elicit this data. So I think, notwithstanding the delay, it's definitely been worth the wait. Based on extensive research in a Wall Street derivatives trading room, Taking the Floor considers how financial organizations might be redesigned to address what Daniel calls the moral shortcomings that culminated in the crisis. He's going to consider instances in which financial models are effectively used, drawing particular attention to, in the book he draws attention to the physical integration of traders' desks as an important method of reducing the blind spots of models. In addition, at the center of his thesis is an intriguing challenge, which I think he will address this evening, namely that there seems to be a link between the models used in financial markets and what he calls, and what others have called, moral disengagement. And he will from this argue, I think, for strengthening informal norms and supervisory relationships in banks, and propose that we bring in some of the elements of maybe the traditional banking partnership model, which had fallen into disuse, back into contemporary financial markets. But I'll let him speak for himself. For Twitter users in the audience, the hashtag for today's event is #LSEBeunza, and we encourage you to use this in your tweets tonight. I would ask you to put your phones on silent, please, in order not to disrupt the event, and to remind you that the event is being recorded and will hopefully be made available as a podcast and a video subsequently, subject to technical difficulties. We also have a photographer here to capture event, busy capturing, and the selection of photos will be made available on our website. So if for any reason you do not want to be part of the images that might be part of this event and you don't want them published, please let us know in advance. Similarly, if you don't want to be in the podcast recording, please choose a seat behind the camera, which I think most of you are. So those are the sort of statements we didn't have to make 20 years ago when I joined the LSE, but now we do have to make them. There's no fire alarm scheduled for today, so if you hear one and are instructed to leave the building, please do so immediately. It won't be an exercise. And as usual, after the lecture, there'll be a chance for you as an audience to put questions to Daniel, but please do try and wait for the roving mic to arrive at you so we capture what you've got to say very clearly. There'll also be an opportunity to get a copy of the book, Daniel's book, signed at the end if you wish, and if you've bought one already, you can bring your book to the front and Daniel will sign it at some point. The lecture will be followed by drinks and nibbles afterwards outside, and you're all invited if you can stay for that. So without further ado, I would like you to welcome Daniel Beunza and invite him to take the floor in order to tell us about taking the floor. Thank you.
Well, good evening to everybody, and thank you, Mike. And special thanks to John and to JP for the invitation to speak tonight. As you said, Mike, it feels special to give this talk today because I've been involved with the LSE since 2009, and I stay currently involved with the Systemic Risk Center, a really special place that allows ethnographers like myself to enter into conversation with financial economists. My talk today is about the weapon that regulators and central bankers last turned to in order to induce restraint into banks on Wall Street and the City of London before electoral changes and other dynamics led to different priorities. And so this weapon is none other than bank culture. And so back in October of 2014, Bill Dudley, then president of the Federal Reserve Bank of New York, organized a workshop titled Reforming Culture and Behavior in the Financial Services Industry. And in his opening speech, he used the word culture 45 times, although he later clarified to the Wall Street Journal that by culture he also meant conduct and ethics. And so culture, Dudley said, is what people do when no one is looking. This turn to culture was based on the belief that the problems were not simply perverse incentives on Wall Street, but also the values of the bank employees. In fact, for instance, in the United Kingdom, the sales review of Barclays following the LIBOR scandal concluded that the bankers were engulfed in a culture of edginess and winning at all costs attitude. And again, the Parliamentary Commission on Banking Standards concluded in 2013 that it was necessary to create a new entity, the Banking Standards Board, to promote high standards of behavior and competence in the financial sector. So in other words, bank culture has been the new regulatory agenda. However, there is a potential risk that this turn to culture and values ends up as symbolic compliance. And so a few years ago, visitors to Canary Wharf were confronted with oversized 3-meter wide signs stating the values espoused by the bank. So for instance, not to single any concrete bank, we see here respect and service. Unfortunately, the bankers I spoke to explained to me that their day-to-day practice have not changed as much. So there was a bit of a mismatch between the lobby in the building and their own office upstairs. Now, in defense of the banks, it has to be said that improving ethics in finance is not easy. Not least because decision-making for the past 3 decades is shaped by complex economic models and equations, such as the Black-Scholes equation. And it's just not very clear how do you take an equation and add values to it, how those two things get combined. An additional sign of the challenge that the banks are confronting is that the social scientists that have traditionally claimed ownership of the relationship between morality and the economy, that is, sociologists, have also grappled with this point. And so some, like Viviana Zelizer, have studied morality in markets from a cultural standpoint and examined the ways in which market actors frame or categorize, while others have, like Michel Callan or Donald Mackenzie, have studied the effect of models on markets. But the people who study models on markets have not studied morality, and those who have studied morality have not incorporated models in their analysis. And so in sum, the problem that needs to be understood is the interplay between models and morals. And that's the topic of my talk tonight, and that's the topic of the book. Okay, but why did I personally decide to take on this question? Or to put it differently, what motivated me to write this book? And to answer that question, I'd like to go back to the difficult month of September 2008, the time of the bankruptcy of Lehman Brothers and the continuous stream of headlines about reckless behavior on Wall Street. At the time, I was on the faculty at Columbia Business School, and what I'm showing you here is a photo that looks like the view from my office. And I had recently completed an ethnographic study of a Wall Street trading room during my doctoral studies at New York University. My colleagues assumed that I was the specialist on how Wall Street banks are run, and so they naturally came to me for answers about these extremely damning headlines. However, I could not help at all, because what I had seen during my ethnographic study was completely different from the headlines that were coming from the media. The people I had seen were, yes, ambitious, but also seemed principled and honest. And so given the disconnect, I ended up spending the entire month of September hiding under my desk, suffering from an academic form of cognitive dissonance. Now, the puzzle was resolved a month later when I found a DVD on the drawer of my desk in my office. And in the DVD, there was a recording of a talk that the manager of the bank that I had studied had given to my MBA students at Columbia. I call him Bob, although that's not his real name. And I called the bank International Securities, although again, that's its pseudonymous name. Now this talk took place in November of 2008. That is almost a full year before the crisis in September 2008. And I'm going to show you here a room that was, if not that precise room, very similar to the room where Bob gave his talk at Columbia Business School. I was hoping that Bob would share with my students his insights about the management of a large bank. And I was hoping that he would talk about the bank that I had studied, International Securities, and that he would in particular impress those who felt that managing was little more than hiring, firing, and paying bonuses, that there was a lot more to it. But to my surprise, on that day, Bob did not speak first about that bank. He spoke about the previous bank that he had been working for before, and he was highly critical of Wall Street. Wall Street banks, he said, are too large and they're too complex, and they are mismanaged. And he added, mark my words, when the next crisis comes, not one, but two of the large banks will disappear. Now it goes without saying that at the time I did not pay the slightest bit of attention to this omen, nor, by the way, did my students. But of course, 1 year later, in October 2008, and once Lehman had gone bankrupt and once Bear Stearns had failed, I realized that his prediction had come true and that he knew something that I didn't know. So I decided to contact Bob again, who by now was the CEO of a different bank, and he explained to me that the trading room that I had seen was in fact quite different from the others. And the reason for that was that before he joined International Securities, he had worked for a different bank that was a leading bank in the derivatives business, and that had experienced a number of scandals before disappearing. And along with the personal difficulty of undergoing all this, he had done a fair amount of reflecting, and when he got the following job at International Securities, he introduced a number of reforms that had made that trading floor unique. And so as I understood this, I understood that the trading floor I had seen was not representative of other trading floors as oftentimes social scientists wish their data to be, but instead was illustrative of how a potential approach at reforming Wall Street might look like. Impressed by the importance of that insight, I understood that I needed to go back to my field notes, but this time from the perspective of the crisis and the perspective of morality and the policy problem of financial reform. So what is it that I saw when I first visited Bob's trading floor back in 1999, at the beginning of my doctoral studies? Well, it was a very unique place. It was far quieter than I expected because information exchange about prices and quantities was done electronically. And what I'm showing you here is not the floor that Bob was running. If I did that, I would be perhaps compromising my commitment for confidentiality. But I'm showing you instead the floor that comes out in the cover of the book, which, if you want to know the bank, it's in the back cover of the book as well. But what that trading floor gives is a similar sense and feeling of uplift as I had when I walked into International Securities for the first day. The floor was specialized in quantitative finance, and so the traders made their returns by using models to price stocks and securities. And it was interesting that the traders saw a moral advantage in the use of models. One, for example, argued that models allow him to better control his own biases. Another one argued that models allow him to attain an advantage and attain profits without having to rely on privileged information. But the thing that was really interesting about these models is that sometimes, as all of those of you who have used models know, the underlying assumptions that make the model applicable did not apply. And so one needed to know not just how to use the model, but more importantly, when not to use the model. The solution that Bob had arrived at was to promote informal communication across desks, because it often happened that when one desk was doing very well, others, the model for the others, the assumptions did not apply. And so what Bob asked of the traders was that they share informally what is it that they're seeing from their desk, from their model. What I'm showing you here is a slide. This is not my slide. This is a slide put together by Bob, showing the schemas about the interdependencies between the merger arbitrage desk and other desks in the trading floor. And so what Bob wanted the traders to do was to collaborate. But what he found is that there were many challenges to this collaboration. And so the traders, Bob told me, they're like engineers. When they think they're right, they can be quite difficult. Others might not be very sociable. I can point you to 10 traders in this room who would be miserable at a cocktail party. And so at some point I asked him, well, why not just pay higher bonuses to those traders that talk to each other? And when I said that, his response was surprising. He said, you know, giving bonuses on a subjective basis, it's fraught with difficulty. If the boss does not give the trader the same bonus as others, that trader will go, I heard Joe at a party, he got 500,000, what, you don't like me? So it can create this type of problems. Even more seriously, Bob discussed the possibility that the traders might actually reject a subjective bonus. Say someone lost money and is due no bonus, but you give that person 40,000 because he was very collaborative. What happens? Well, if he is gracious, he just takes the money. But more often than not, he might be insulted and he might quit. This was particularly surprising for a PhD student like myself on a tight budget. But at the same time, it sounded like this is how most people function. They are liable to be offended when their moral principles are challenged. And in fact, what was really interesting was that Bob's theory of motivation incorporated not simply more money, more work, but rather the idea that psychologists have outlined of organizational justice, which is the idea developed by Gerald Greenberg in '87 that perceptions of injustice impact job attitudes and behaviors at work. And so instead of paying bonuses to promote collaboration, what Bob did was he tried to promote trust by making sure that the room was not too big, 150 people maximum. He moved the desks around occasionally. His idea was that close proximity breeds trust, and then trust creates communication. He kept screens low so that people would see each other. And so overall, the trading floor reminded me of what organizational sociologists during the mid-20th century called an organic structure. Non-hierarchical, non-bureaucratic, and very close to my own academic values. But here's what was surprising. If I now fast forward to 2007, in the lecture that Bob gave to my MBA students, the person that came in through the door did not look anything like the manager I had met in the bank. Bob surprised me with his level of energy and the powerful tone in which he addressed my students. He even called some of my students. And to my surprise, the students were fine with this. They accepted his authority. And what I understood then was that power, when it is well exercised, it can be invisible. And that it had most likely become invisible to me during my field work. And I also understood that I hadn't seen the process by which Bob had established his authority in the trading floor, just as I had seen how he managed to establish his authority with my MBA students. And so, shocked by this, I decided to ask him about it, change my schedule for the afternoon, and ask him for a talk. He explained that it had been key for him to establish norms in the trading floor. And so, some examples of this, I'm going to give you now, that he gave me. Once he organized a retreat. The co-head of the trading floor was late. Bob had everybody inside the room, and the co-head popped the head inside and said, can we come in? And Bob's answer in front of everybody was challenging. No, none of you can come in. And then he made a joke, a self-deprecating joke. You'll have to spend time with me alone. That's your punishment. And so he was very willing to hold people to his norms. He did this in different ways. I won't go into detail. But to sum up, what was clear that the reputation that he developed and that he allowed to persist was that he would burn down his own house before compromising on the values. So that was a real surprise and allowed me to understand that it was really a world of organizational norms rather than one of market incentives that was driving him and that was explaining what I had seen on the trading floor. But even as Bob explained this, there was something that kept nagging at me. After all, if I had been in his position, I would be quite proud of the job done. But there was a trace of negativity, or perhaps ambivalence, when Bob spoke about Wall Street. He retired several times, and each time he planned not to return to Wall Street. He did not like to live in a town that was primarily occupied by other Wall Streeters. And so there was something dark about what happens on Wall Street that Bob and his militant intransigence was addressing. And for the life of me, I could not empathize with that feeling. And so I decided to change my research design and switch to oral history interviews. And in 2015, alongside with interviewing a number of traders that I had followed between 1999 and 2003, I asked Bob to sit with me and a tape recorder to clear his entire day and to give me the grand tour of his career. And it was there that I finally understood where that darkness came from. And so the bank that Bob worked at between 87 and 95, the pseudonymous name that I give it is Premier Financial, essentially was at the forefront of the derivatives revolution. Equity derivatives, commodity derivatives, credit derivatives, and the absolute globalization of the business. And Premier was the innovation firm. And so they were in the vanguard of that revolution, thinking about how to rationally organize financial flows and securities, and imagining how all that would look like. So I'm going to show you a couple of figures to illustrate this discourse of rationality and disruption that was going on at Premier. So one is the growth of the OTC derivatives market, just really, really high. Notice the drop after the financial crisis, but notice that it hasn't gone away. And this is an example of a foreign currency swap with Premier at the center. That's the type of over-the-counter or made-to-measure derivative that the bank would market. And so there were a couple of episodes that shaped Bob's experience at the bank. The first of which was a scandal in which the subordinates of Bob in New York flew over to some country and they sold toxic derivatives to customers of the bank, and those derivatives blew up. The customers incurred very heavy losses and they were outraged. Bob, although it was not his responsibility, flew in to address the issue, and he resolved the dispute. How? By settling. The bank took some losses, which meant fewer profits. The customer took other losses. But to Bob's surprise, the managers, the top management of the bank, ops, were unhappy with the situation. They felt that the customers had signed the contracts, and so that the customers should pay. And I think that is illustrative of a transformation that has taken place over the years, whereby banks deal with other companies, not on the basis that they are customers, but that they are counterparties, that they are people that you trade with the understanding that we are both knowledgeable and that we don't have obligations to each other. The other development that shaped Bob's recollection was the introduction of financial models, not for the purpose of pricing securities, but for the purpose of control. And so Premier, alongside with other banks, developed a means to quantify the cost of risk. Now, this sounds very abstract, and it was a very difficult thing to do, that essentially placed an economic model at the heart of decision-making in the bank. And so this methodology, or the broad family of methodologies, is called value at risk. And the CEO and chairman of the bank told Bob that this is how he was now expected to manage risks. So they told him, you may think that you're taking too much interest rate risk, but look, maybe somebody else, perhaps in prop trading, will have the opposite view. So now you have different exposures that will compensate each other. And so net, this is not a problem. And what's your problem? Bob, step on the gas. My reading of that development is along the lines of the concept of economization, sociological idea developed by Koray Kaliskan and Michel Calon. And it describes the process by which something, in this case risk, is placed into the realm of the economic. And the way that it happens is by the introduction of a tool, such as value at risk, that is combined with decision making, so that decisions are now made on the basis of the tool. So the trouble that Bob encountered was that these risk models used for control actually were not perfect. As with everything, they were not infallible. And the problem that they created is that the model quantified an expected level of losses. When that level of losses exceeded a certain threshold, the bank forced the traders to liquidate the position. In doing that, the trader then turned what seemed like just a paper loss into an actual concrete tangible real loss. Even worse, if the model turn out, if the value at risk, the risk management model turn out to be inaccurate, the trader could then witness the evolution of prices and quantify the returns that he or she would have been able to make, as opposed to ending up the year with no bonus. The result of this feeling of injustice was that the traders absolutely hated it. They spent all day examining the risk management system, finding its intellectual deficiencies, to humiliate them, the risk managers, and to drive around that barrier. And so I believe that this speaks to another concept developed by social psychologists, which is moral disengagement. What that is situations in which a perception of unfairness leads to the detachment of immoral behaviors from self-condemnation or other negative emotions. And so, taken together, if we combine the use of the models, the organizational injustice, and the moral disengagement, the concept that I propose to designate that combination is model-based moral disengagement. And by that, what I mean is a discursive material mechanism that entails the weakening of the self-condemnation caused by perceptions of injustice associated with the use of imperfect models to manage the organization. And so this mechanism can take many ways. The incorporation of a value at risk model in the strategy led banks, and especially Premier, to shift from corporate relations to capital markets. It led to a discourse of rationality and buyer beware on the part of the CEOs. It weakened the control that the managers could exercise, and it led to a sense of injustice. And it also allowed for customer losses at the benefit of the bank, because the use of models could create more and more complex derivatives. So the question that, as I see it, comes up from this is, well, if models can create disengagement, how to prevent that? And so to address that question, I'm going to go back to the trading floor that I witnessed in 1999 to 03. And I saw 4 specific practices that deserve analysis. Number 1, there was no lucrative over-the-counter derivatives business at all, because Bob felt that this just created too many opportunities for abuse. Number 2, the data from the risk management model was completely ignored for the purpose of controlling traders. Instead, Bob relied on himself and middle managers in the trading floor and the daily conversations and their own judgment. Similarly, there was no subjective bonuses, but rather a fixed percentage of the profits made by the desk for each trader, which was a way to address the problem of organizational injustice. And so, taken together, if I build on the basis of this, what I propose is another concept, which I call proximate control, and by which I mean material and discursive mechanisms, meaning ways to work, tools, and ways to talk that reinforce organizational norms and relations, and that preserve a sense of justice and sustain self-condemnation when norms are breached. And proximate control is not incompatible with technology. It's not a Luddite thing. It's compatible with the use of models for the purpose of valuation, asset pricing, but it is not compatible with the use of models to replace the work of managers. And it is not compatible either with banks of a very large size, because more likely than not, they are being controlled through the use of models. And here's 3 examples of how that plays out. At the level of strategy, avoid businesses that create the risk for customer abuse. At the level of discourse among the top management, a discourse of responsibility as opposed to a discourse of disruption. And at the level of control, an emphasis on managerial engagement, an emphasis on judgment, and an emphasis on moral intuition. The idea that the managers themselves should be able to make a moral judgment about the degree to which traders are fit to have a certain position or not. And so in conclusion, I started this talk talking about bank culture and the new approach at financial reform and restraint in Wall Street and the City of London. And I have made 2 arguments. The first is that models can create moral disengagement, that there's a danger there that needs to be addressed, and that this risk takes the form of model-based moral disengagement that I outlined. The second is that to prevent this disengagement, the banks need to be reorganized so as to incorporate morality and avoid those processes of moral disengagement. And so, tonight, I would like to close by calling for a better appreciation of the role of managers in the banks and the financial institutions that we have. Good management is far more than just hiring, firing, and paying bonuses. And unless the complexity and the nuance that is involved is not appreciated, the task of managing in finance will never be a career for those who are now choosing to join the sector. And I hope that in the future we see better management in our financial sector. Thank you very much.
Thank you very much, Daniel, for that very rich talk, and I'm sure it's got a lot of people thinking. So we now have some time for questions. If you'd like to ask a question, it would be nice if you could identify yourself and your affiliation and just wait for the microphone. I was going to ask some questions, but I think the hands are going up, so we're going to go to the floor. So just at the front here first, and then 2, 3. Thank you.
Hi, my name is Stefan. I'm a student and a master in finances, and I would like to ask, what do you think is the role of regulation in improving the management of, for example, a trading floor or a financial institution, and what type of policies should be made in order to improve that? Thank you.
So, I just take them one by one?
One by one for the time being, yeah.
Okay, very good. So, so the role of regulation, obviously, it's a key part of the reform of the financial sector. But the danger that we have ahead of us is that the regulators now have embraced similar controlled approach as the managers of the banks had in the past. And so a mechanistic approach, capital requirements, Basel II, that have demonstrated that they don't work at times of crisis, because those models do not capture the real risk. And so the paradox is that faced with the problems of this mechanistic approach at control, the Basel Committee has come up with an even bigger model that is likely to lead to a similar efforts at sidestepping its functioning, hence the interest on the part of central bankers to address the culture of banks.
Thank you. Yes.
Hi, it's Ali Sufyan. I work at a bank in risk management. In terms of your the conclusion and in terms of that feeling of injustice, do you think, I was going to say, regulation also breeds some of that? And to a certain extent, does the model also need to incorporate greed? So in the cases of rogue traders that we've seen recently, is that also a factor? And that's only come about because the regulation allows you to circumvent and therefore creates a constant sense of injustice that you then exploit. Does that fit into the model somehow?
Yeah, so the question is about greed. And I think that obviously both in finance and outside finance, people are driven by interests. But what seemed peculiar to me is the idea that there is a moral element as well as a psychological trait such as greed. There's a moral dimension that is driving what people do. And as you just pointed out, sometimes the point is not that people advance their interest without any restraint because they're greedy, but rather because the restraints in place are not legitimate to them. And so that's the mechanism that I would like to highlight.
Santosh Arkula, worked in academia, worked for consulting firms, and currently working for a few banks on risk and regulations, primarily on the market risk side.
I'm sorry, could you speak closer to the mic? I cannot.
Sorry, yeah. Is it better?
Yeah.
Wonderful. So my key question is like the trading is changing quite a lot, like, click-based trading to, the voice-based trading to algo trading. So if we take machine-based or algo-based trading, how much the morality comes into picture? Will it be relevant in the future? That's point one. And question two is like, have you compared the way banks work with some of the big technology companies likes of Google work? Because in terms of revenues, likes of Google have far exceeded the revenues of banks or investment banks. So did you compare the culture in big technology companies which can be adopted in banks?
Okay. So the two questions, if I understood correctly, the first one is not on models, but on algorithms.
Yes. So, so like when human interaction involvement becomes less with algo trading, how far the human element of morality comes into picture? Will that be relevant in future or not?
Yeah. So that's so the domain of algorithms. Actually, it's a very appropriate question in this setting. It's only, I believe, 5 years ago that the Systemic Risk Center organized an event around algorithms and around the so-called flash crash that took place in the US in 2010. And so I haven't examined the morality of algorithms in this project, but in a different project where I looked at the way in which the New York Stock Exchange automated its trading floor. What I found is that the one complaint and the one concern that the floor brokers and specialists had with automation is that they on the floor were expected to adhere to some informal norms about, for example, market participation in situations of crisis. But the algorithms that were replacing them did not have obligations of that sort. And so I think that the challenge for designers of markets is to see how can they preserve elements of the old as they create the new, so that issues like morality are still taken into account. Your second question is about technology firms, And I have to say that I haven't studied them, so I would not be able to comment. The one thing that struck me as I heard the description of Premier Financial is that they were in the business of disruption, as so many tech companies seem to be today. And it seems to me that that can very easily then lead you to take distance from prevailing norms. So that would be my only comment to that.
Okay, I think we'll collect a couple of questions. So there's one at the back there and one on the side. Oh, sorry, okay, you start. Yeah, thanks. 1, 2, 3.
Daniel, my name is Chris Roebuck. Daniel knows me. I have to say Daniel knows me. And I have been head of leadership for a global bank. We won't say which one. Just say a few words about the fundamental issue that is created by banks adopting what are effectively rational processes which seem to completely, to some degree, ignore the emotional behavioural characteristics of human beings and fundamental principles of their behaviour in a way that is predictive that something is going to go wrong at some point.
Okay, so there was a lady in the middle who needs the mic just here, please. Okay, you go first and then...
Daniel, Andrew Mossop. I've worked for many years with banks, especially on the risk function. I wondered what your thoughts were around, especially on trading floors, a culture of promoting rainmakers to management positions as opposed to people managers. And the second point I wanted to make was a tendency of banks to cyclically forget and let go the risk managers who went through the last crisis and therefore could carry valuable experience into the next one.
Very good. And in the middle, yes.
Hello, I'm here. My name is Ana Carolina. I am studying the Master of Law here in LSE with the specialization in banking and finance. And I've been working as a lawyer, as in-house counsel in financial institutions for the past 10 years. And I would like to know if in your researches you have found something related to the imbalance between the trading floor and the so-called back office and middle office, terms that I personally hate.
Okay, Daniel, 3 questions.
Sure, thank you. So let me start with Chris. Chris, thank you so much. So you and I have had some wonderful talks about the challenge of management, or as you put it, leadership in the large banks. And what I would say is that I could not agree more with your comment. If one introduces these rational, mechanistic processes, they are bound to interfere with people's sense of what's right. And one of the things that is most shocking about my book is that, of all people, academics have had a terrifically positive reaction, because we in academia are also being managed by a process that many see as overly rationalistic and rigid. And so it's when I find this sort of like support close to home that I see that perhaps this book is speaking to something that goes beyond finance. To the gentleman's question about rainmakers, the answer is absolutely. This is one of the key challenges. And so maybe I'll share the way in which Bob dealt with one such rainmaker. In his case, it wasn't a rainmaker, strictly speaking, it was a star trader. The star trader of the floor. And so there was 1 year in which, this is in the bank that I followed for 3 years, International Securities, in which the star trader of the floor came to him and said, and this was a year in which he had made the greatest profits for the bank than any other bank, I mean for the trading floor than any other trader. And so he went to Bob and said, look, I understand that we had an agreement that I was supposed to take whatever percentage of the profits that I generate. But I thought it through and I think that I want more. And so I think that I am deserved more because look, I made so much. So now Bob was faced with a real dilemma. What do? If you say no to the trader, you run the risk that he will go elsewhere. And if you say yes to the trader, then the rest of the people are bound to find out. And so then everybody will know that you're not standing behind your own norms and rules. So what to do? And to make things worse, it was a bad year. So the other traders hadn't made that big of a profit. And on top of it, this was a particularly difficult and antisocial trader who almost physically came into contact and friction with the others. So Bob took all this in and got back to him and said, look, here's a check for the amount that you are due per our contract. And now you're fired. You're fired for not accepting an agreement that you and I had a year ago. And so I'm sure that this is not an easy thing to do. I'm sure that this is not something that can be easily or casually advised. But I think it's a real example that if one is to take seriously the norms that one lays out, one needs to take extreme measures such as that. It was the last discussion about bonuses that he had. And to the point on the back office, it's so important, this awful divide between so-called front office and back office. And so here's what Bob did. He was very aware that this was not a good thing. Why? Because people in the back office hold valuable information for the traders. But the traders oftentimes mistreat them on the grounds that they have degrees from lesser universities, or that they make more money than they do, or that they have greater status. So what Bob did was he set out to reverse that situation. First of all, he eliminated the wall that divided the front office and the back office. They were both on the same floor. Second, he began a program with the head of operations, who was running the back office, to start to identify back office employees who could be promoted to the front office. And pretty soon, without involving HR, he created an internal career system where the back office people began to be promoted to the front office. And so very quickly, that eliminated that perception of his status imbalance. And so I think that speaks to the problems of these divides and the advantages of overcoming them in the organization.
Good. Okay. So Mike at the front here, and then one in the centre, middle, the gentleman in the pink shirt. And these three will come later.
I'm Kevin James from the Systemic Risk Center. So there have been plenty of crises historically in the US and the UK before there were any models, and there are plenty of crises outside of the developed world which don't involve models at all. So I'm really wondering, how sure are you that models are driving kind of this sort of crisis-prone behavior of banks in the current period?
Okay, hold back. Sir?
Naresh, and I'm a teacher. My fundamental issue is that I think it's very, very difficult to take away that profit element from a trader. Traders driven to maximize their profits. How that profit is measured through some kind of risk adjustment, model adjustment that's used to measure that profit, they will find ways, and they will look at ways in terms of how their risk is measured versus how they can circumvent those measurements in order to maximize their profit. They'll be rewarded for taking as much risk as possible. There is no incentive for them to take little risk, because rewards are based on risk versus their return ratio.
Thank you. Lady, you had your hand up a few times, so yeah. Could you send the mic back there?
Hi, this is Juliana. I'm an academic from across the road at King's College. And Danielle, I really enjoyed your talk because I think this notion that models can create moral disengagement really resonates, I think, beyond financial markets. It really resonates with a lot of my own experience. Because I think what happens is that models take out the human judgment and just outsources it to these rational models. I want to ask one question, whether you think that models can there be models that can create moral engagement rather than disengagement? Or is there something inherently about models that create disengagement, which means, as we enter, as has been mentioned before, the world of algorithms and artificial intelligence might mean quite a bleak picture for morality. Thank you.
Thank you. So let me start with the first question about models. I think that your question is really about the limits of my argument, meaning to what extent would addressing model-based moral disengagement then remove crisis, for instance. And so I would say that my argument is that models create a new form of risk and danger. It's not that they are behind all the crises that we have seen, but rather that they are an innovation that has appeared in the past decades, and that this is something new that we need to start thinking about. If one goes back to the Great Depression, crash of 1929, well, certainly there were no models then, but what I would say is that the models were involved in the crisis that we have seen recently. So I guess that it's an issue of, I am particularly addressing those forms of crisis and those forms of situations where models are involved. If one goes back to the analysis by the leading sociologists of the 2008 global financial crisis, so Donald McKenzie, or even anthropologically informed analysis such as that by Gillian Tett, they are both very clear that models were centrally involved in the crisis. So that's the type of problem that I am addressing. On the point of the impossibility of measuring risk that the gentleman asked, I would agree. I think that the moment that you start to measure something, then you are opening yourself to then reactions on the part of those that you're trying to measure. This is something that sociologists have known for many years, that we humans are reflexive. And so when we are acted upon, then we act back. And so I am not advocating for a different way of measuring risk. Perhaps the best way of dealing with risk is by not measuring, but simply by talking to the person, talking to the trader, and undergoing the interpersonal process that takes place when two people talk and one assesses what's going on in the other person's mind. And that is what Bob and his team were doing. They were sitting next to the traders and trying to understand what they were doing. And then the last point, question asked by Juliane. It's a wonderful question. There's nothing in my fieldwork that speaks to models that do not create disengagement. But what Bob was very quick to point out is that he was not against technology or models to evaluate securities, to evaluate assets, and that in fact, if one goes back to the 1920s, the way that investment banking was organized back then, they were all essentially networks of firms that, with the current social media information processing technology, which you could then perhaps see as close to technology for models could now be reproduced, so that you don't really need a bank of 100,000 people to be able to take a company public. You can rely on networks of smaller organizations, which is what we had in the 1920s before banks then later on became huge.
Thanks. I'm going to exercise my chairman's prerogative and ask you. I mean, you said something very interesting in the book, which is implicit in your presentation on page 207, actually, that risk models are political and that have enabled firms to grow. So they're somehow associated with growth, and but also intriguingly associated with a transfer of power to the centers of those organizations. And this is a theme of models as disciplinary kind of constructs, which you don't touch on so much in the talk, but is reasonably prominent in the book. So I was wondering if you could expand on that sort of political, disciplinary feature of models that you articulate.
Yeah. It's thank you for the question. It's a really important aspect of the problems that Bob shared in his thinking about the models. So what he said is that why the models are so useful to the banks themselves is because they allow them to operate under the pretense that they know exactly what risk they are exposed to at any given point in time. And so that allows you then to grow in size way beyond the size that would allow any normal CEO of a bank to know what risks the bank is facing. And so, in his words, the situation that ensues is one where the job of the CEO of a bank, of a really big bank, is an impossible job, because it's impossible to know across 20 countries, multiple business cycles, multiple asset classes, what is the actual risk that the bank is faced with. And that at the core of these pension for models is a large size, and at the core of the advantages of the large size is that, of course, there are more resources for the people on top of the organization. And so the challenge then becomes, how do we move into a system that is not like that, made up of small size banks? And that is an open question.
Thanks. John at the back, and then
So my name is John Danielson. I'm the director of the Systemic Risk Center, and I'm really grateful for Daniel and Mike for having agreed to do this event. I've been following Daniel's work for many years, and every time I see him presenting, it's better and better. So I was really wondering what happens when I see him next year, because it keeps on improving. But even though I'm of course a quantitative finance person, I agree with everything he says, which is quite unusual for me. But I have two questions for you. So one of your fellow sociologists identified many decades ago the concept of the McNamara fallacy, talking about Robert McNamara, who was around the Vietnam War, whose philosophy was, if you can measure it, measure it. If you can measure it, control it. If you can't measure it, ignore it. And we know what happened to the Vietnam War. It's a very nice, insightful analysis. Now, listening to you and sort of following trends, it seems like things are getting worse, because almost everything we do is based on measuring things, put them into a statistical model, machine learning, and put algorithms on top. Banks are looking to lay off a large number of their employees and replace them with algorithms, which are basically sophisticated models. So the question to you is, are things getting worse? And what should those of us who teach models and modeling do as academics?
Good. Hold the thought. So there's a gentleman there, and then Matthew.
Joel from Research for Action. We broke a story on Lobo loans, which involved abuse of informational asymmetry by UK and European banks, mis-selling loans with derivatives to UK local authorities. So these are relatively unsophisticated clients. We found two contributing factors in these cases. So caveat emptor, which was let the buyer beware, so no duty of good faith between banks and their clients, and effectively no regulations, so councils being outside regulatory protection, and the Financial Conduct Authority not looking at commercial loans. And despite, of course, taxpayers losing out billions of pounds in these loans, there's been no one held responsible. So my question to you is, in your opinion, where does the blame lie for this ongoing regulatory failure? Is it with regulators for failing to enforce the laws we have? Is it with politicians for being captured by the financial sector? Or is it with customers for being too stupid or unsophisticated to understand this increasing complexity we're seeing in these models which you set out?
Mike at the front here. Are you still a regulator, Matthew? You answered that question.
Matthew Gill. It's a related question actually on the practicalities. This is really clear and fascinating, but it leaves you with quite a big ask, which is you're asking people to manage and to be managed in a way that's increasingly unfamiliar or different to what they're used to, and to do that in smaller organisations. So the question is, in a way, how do you get from here to there? There's optimism in what you've described around the illegitimacy of the current arrangements that give people an impetus to want change. But if regulation, as we currently understand it, isn't the answer, how would we bring that change about and get more Bobs, smaller organisations into the mix?
Okay. Well, in a way, these are three wonderful, very complementary questions. One of them is, have things gotten worse rather than better for the past decade? Are regulators to blame for the situation that we're in? And if we are not in the good situation, then how do we get to this world of smaller organizations where employees are not controlled by models? So I would say that mine is a case study, and so I need to be very mindful of making broad statements about the state of the financial industry. But what I can say is just the ways in which my relatively narrow study speaks to the present situation. Certainly, the fact that the banks were bailed out is bound to have made the situation worse rather than better, because essentially what it has done is it has preserved the structures that in many ways were to blame for the problems in 2008. I can only imagine what would happen to me if suddenly my own organization is responsible for terrible losses for society, but is kept intact, and I continue showing up for work on a daily basis with all my colleagues, my bosses. It would be very difficult to change. Whom to blame? Perhaps, certainly one element is the fact that the system was made to persist as it is. I think that rather than talk about blame, I think the challenge in addressing the system is that so far the diagnosis has been made on the basis of greed, conflicts, incentives, which speaks to a dimension of human decision making that so far has ignored morality. There are good reasons why morality has in many ways dropped from day-to-day conversation. It's even dropped from mainstream usage in the field of sociology. It's only making a comeback now. And so I think that perhaps part of the problem is that in diagnosing what went wrong, the models informing regulators lacked the moral dimension of economic action. And finally, how to go from here to there? Well, I'm very glad that I was asked this question. And I have to share with you that I asked this question to Bob myself. And the answer that I received from the CEO of a bank was absolutely perplexing. Because what he said is that the state of affairs is so complex, so difficult, and it's so difficult to prevent the large banks from, in many ways, absorbing all the benefits that can be reaped from financial innovation. And let's remember that he was running a big bank. It's so difficult, and the big banks hold such power over regulators that the only way out is to break up the big banks. And so when I heard that, I was absolutely shocked. Because up until then, I thought that the idea of breaking up Wall Street was something just more apt for the fringe left and people that protest against various things. But shockingly enough, it's now something that at least one CEO of a bank on Wall Street believes needs to happen. So I won't elaborate, I'll let that sink in, and as you follow the American presidential campaign, where more than one candidate on the Democratic side has the breakup of Wall Street in their program, that's something to keep track of.
Daniel, just on that point, I mean, you began your talk talking about culture and the various reactions to the crisis in terms of having to fix culture. Given what you've said, do you think culture is just what we do because we're too scared to address this question?
Is the bank culture agenda a response to the difficulty of doing anything else? Is it just a way out? Is it just a ceremonial exercise on the part of regulators who are keen to be seen doing something? Well, I'm not sure. I don't know. But I will say that what every organizational management scholar who has studied organizational change will know is that certainly it's impossible to exert durable organizational change purely on the basis of structural measures, such as separating proprietary trading from commercial banking, which is what we have now seen in terms of reforms. And so in addition to structural reforms, one needs cultural reforms. And so in a certain state of the world, cultural reform would be just the thing that is needed. But given the present state of the situation, it's possible that unless other things happen, cultural reform on its own might not attain the goals that regulators have.
Okay, good. So we're going to take some more questions. So this lady in the further row, and then we have two questioners in the further behind. Please.
Hello, I'm Ithiar. I'm also an academic. Ithiar, an academic from Surrey Business School. Daniel, you start your presentation criticizing the effort of moralization or developing culture in the banks. But my understanding of why rational models from an ethical point of view were put in place were not only to control risk, but also to prevent the abuse of excess morality over increasing diversity staff. So if your proposal is to break up the banks and to let the managers have more freedom to manage on the basis of morality. What are the risks of not allowing diversity and not allowing a different morale within your teams? And this speaks to the introduction of, for example, women in management or people with different set of ethics, right? Because your managers are very homogeneous white men, probably Catholic, with a very defined set of moral standards, right? Thank you.
Okay, and then Atul.
Hi, Atul Shah, City University, and Daniel's colleague. Well done, Daniel. That was fascinating. Thank you. My question is around morality and finance theory. If we look and focusing around education, how finance is taught at universities and theorized, the way I see it, morality is very far from contemporary teaching in finance, or you could say there is a particular type of morality which is about materialistic wealth and profit maximization, wealth maximization, that kind of thing. So looking at your research where you're trying to tease out the morality in a trading room, what would you say if we wanted, and given the kind of wider issues we face today around sustainability, inequality, etc., to me, there is no doubt that morality has to be at the center of finance theory, and so does culture. I think culture also needs to be at the center of finance theory. At the moment, they are both not even peripheral, in my view. So how can we take some of your ideas to build what I would call an organic theory of finance? Thank you.
Okay, thank you.
Hi, so my name's Tiffany. I'm still in school. I was wondering, since we're moving on more into tech and AI, and since the fact that AI is just a bunch of machine learning, sure, there are like trends to base them off, but things are constantly changing. Surely by just leaving stuff to AI, that's really risky, and isn't this just a blame game for the traders and sort of allows them to take risks, like bigger risks and stuff?
Okay, thanks. You can wrap it up then.
Okay, very good. So, so if I can sum up, there was a question about the risks of the concerns about potential diversity in a financial sector made up of small firms. There was a question about how to integrate morality into a theory, an organic theory of finance. And there's the question of AI, and is AI not simply a form of, in a way, disengagement on the part of the traders, just outsourcing to the algorithm responsibility. So, regarding the diversity, it is true. For those who read the book, that my book has a very serious limitation, which is that on the trading floor that I did my research on, there were no female traders, nor ethnic minorities that I reported on clearly in the research. And so that's something that now needs to be addressed, and it's a very important part of the agenda of research going forward. So there's been this extremely provocative question that if the Lehman Brothers had been the Lehman Sisters, would the bank had gone bankrupt? And I think that's something that needs to be understood. I am generally wary of accounts of the world that are purely based on the individual demographic characteristics of the actors. But luckily there's a vibrant stream of research on gender in finance. There is the work of the anthropologist Melissa Fisher and others who are addressing these issues. And I think that a conversation is very much overdue that integrates these gender issues into the type of theories that I am putting forth. So the short answer, I guess, is I don't know, but I'm getting there. With regards to the integration of morality and existing economic theories of finance, this is something that needs to be taken into account and analyzed, I think, with compassion rather than outrage. Because it's only normal that these factors that had not been as part of the conversation, it's only normal that integration of these issues is going to take time. And so what I know from my extremely well-intentioned colleagues in finance is that they themselves are perplexed when somebody in the class asks questions about the morality of a certain model. And I know they are perplexed because over coffee they tell me they are perplexed. So it's an issue of integrating. And it's the same issue that we have in the case of responsible investment. And so now there is this growing field of environmental, social, and governance factors being integrated into investment practices. But when you really talk to the practitioners and you ask them, okay, so you're integrating this, that is so wonderful, that is so great, and how are you doing that? The answer that you get is, well, this is confidential. And so, bottom line, I suspect, is that they also are having challenges integrating it. So I think that this is the challenge for us academics, and certainly the challenge for me as an academic. And my own efforts are at finding ways at reaching in the classroom, in my class, students from finance degrees in my business school that might not otherwise been exposed to these ideas. And finally, on the point of artificial intelligence, so yes, I think that algorithms are peculiar in that they have their own agency, and so they seem to act on their own, which seems like a wonderful pretext to then let off the hook the person who is running the algorithms. But what my research, and again, I have to emphasize again, and I have, by virtue of what year it was, this book has very few elements of algorithms. But again, going back to my own research on the floor of the New York Stock Exchange and how it was automated, the understanding that the co-author in that project, Yuval Milo and myself, came to is that the floor managed to combine the algorithms with the existing organizational structures of the New York Stock Exchange so that the people who were behind the algorithms were able to be responsible for what the algorithm was doing. So what I would say is that, and perhaps it's useful if I share the name that we gave to this process. We call it blended automation, where you take elements of the new, but you combine them with the structures from the past so that you preserve these elements like moral responsibility that you would otherwise not have. And so Mike has asked me to stop. And so I shall stop by thanking you all for coming and thanking Mike and the Systemic Risk Center for this wonderful occasion. Thank you.